Welcome to Thought Leaders, featuring interviews with some of the best minds in the industry. Today's special guest is popular platform speaker, financial columnist, and best-selling author, Tom Martin. Hello everyone, I'm Steve Savant, syndicated financial columnist and talk show host. In this segment, we're introducing you to why it's problematic for individuals to try to match up to index universal life policies. All from Tom's popular article, Our Caps and Floors in IUL Realistic, and his best-selling book, The Other 8 Advantages of Universal Life. I have to say, most of the time, I don't hear too many clients trying to do this, but there are many clients that are highly sophisticated. As you move into the more affluent market, you're going to meet people that say, hey, I'm just going to do this with my options trader. He's very good at it. He knows how to do it. Why is this the myth that you can somehow replicate index universal life? Let's just talk about the option issues first. Forget about the tax advantage for a moment, but let's just talk about that issue alone. Why can't they actually replicate what the insurance carriers are replicating?
Well, Steve, the real key is in the safe money account. And I've had clients imply that they could do the same results or better than what they could get in an IUL. Now, I'm not saying that they can't produce a better return, but they're taking risk. There's no way for a client to be able to replicate the 0% floor, 10, 11, 12% cap strategy that they could receive in an IUL. And the real reason, main reason, is because where are they going to get 5% safe money in today's day and age?
Okay, well, where are the carriers getting it?
Well, the carriers are getting it because their general account is earning generally 5 to 6, maybe 7%. And the reason why is they're taking very long-term bets. Mm-hmm. And they can afford to give us those 5% safe money rates because they're making money on our mortality charges, they're making money on policy fees, they're making money on the spread, they're making money on surrender charges.
Premium load.
Policy loans.
Yeah.
There's plenty of ways for them to make money, and they just need to earn their 5-6% general account yield to be able to make good on their long-term promises.
Okay, so I can't go to my own portfolio as an individual. I produced, it isn't going to be 5%, but I at least got 3%, let's say. I was able to produce out of that. I could not replicate that strategy.
If you look today for an investment that was guaranteed for 1 year. And again, you need to have a guarantee of not losing money because that's one of the beauties of the way these work. When the market takes a loss, even if we take a 2 or 3% loss, year two we've got to recover that 2 or 3% loss before we're back into the profit. If we have a worst case scenario of 0, we never lose ground, and that's one of the things that makes it work. So if we were trying to find a guaranteed return in today's market for 1 year, what do you do? A 1-year CD for under 2%? You might do a zero coupon bond. You might get 2 on that. So suppose we found a 2% zero coupon bond, and we needed to, getting back to our example of a $100,000 account value, how much would we need of our $100,000 to be in that zero coupon bond to equal $100,000 at the end of the year? And the answer after taxes is about $98,900. So that really only gives us an option budget of about $1,100, where on an IUL the option budget was about 5 times that.
So if I'm hearing correctly, the long haul positions of carriers in their bond portfolio they've already been thinking this through in advance. They're pulling, like you said, maybe between 5 and 6%. The actual market doesn't go that long. Almost all investors don't go that long. They're much more short. And right now, as we know, I mean, the interest rate market is terrible. Right. So you're not going to get anything, even if you try to get a nice 1-year out option. Your best you might be able to do is maybe 0.75 to 2.25, somewhere in that vicinity, depending upon the institution. So let's just say we've eliminated that issue. Now, we're happy about indexing because I think most consumers go, I love the idea of not losing money in my account. Now, they still have policy expenses to pay. You could actually lose in a year. I just want to make sure I say that as well, because the policy expenses could be deducted from a 0 crediting year. But you're not going to lose because of the actual market in itself.
Exactly.
Okay,
exactly.
all right. So people look at that. Now, the secondary area they look at is the tax issue because, we're talking about insurance. I could take strategic withdrawals of basis and policy loans of gain, or if I was arbitraging, I could use participating loans, right? When I come back, when we talk about these things, I'm always trying to compare, should I go index annuity long haul or should I go index life long haul? And there's a little bit of debate about that. But my question to you is, if the carrier's positions are, as you said, and the actual position of the client is trying to replicate it, he'll never be able to replicate not only the safe money rate, but they're not going to get the strategy on the withdrawals to basis, well, maybe on the basis, but not the policy loans.
Well, but not only that, they're not going to, if we had an individual investor try to replicate the strategy, not only do they have 80% less money to play this option strategy with, their option strategy is going to be taxable to them. At a potential tax rate of 40%. So they not only have 80% less money.
By the way, that's a huge point because most of the options we're talking about are going to be short term, right? So it's all going to be ordinary income tax. Is that not so?
Well, and the option that we talked about, I believe the expiration date was within a year, which would have caused our investor to see a short-term capital gain. I would, if I were to try to replicate this in an individual investment, I would certainly go on the longer end and make sure that those expiration dates are at least a year, because I'd rather have the long-term gain than the short-term gain, but I'd really rather have no taxes at all.
Well, listen, for more information on the mechanics of Index Universal Life and how this information can impact your practice, just click on the landing page address in the video description. We'll be right back with more from Tom Martin.
This is your website. Few people visit, and if it isn't attracting new visitors, it's not doing its job. Now you can drive more visitors to your website through dynamic content and email marketing with CreativeOne's Social Media Elite. Capture quality leads faster and easier. Engage your visitors with informative articles and videos to boost your online credibility. Plus, stay connected with existing clients and earn more referrals. All content is customized for you. It's time to introduce your website to the world. Call your CreativeOne sales team at 800-992-2642 or visit us online at creativeone.com.
In this segment, we're introducing you to why we use option strategies and cap adjustments for Index Universal Life, all from Tom's popular article, Are Caps and Floors and IUL Realistic?, and his best-selling book, The Other 8 Advantages of Universal Life. Well, let's summarize some of the things we've talked about. And then I have my golden question of annuities in life. We're talking about, throughout this whole day, we've been talking about other strategies that the carriers use. Now they use their caps. In the previous thing, we talked about, hey, if you hold this long enough, your caps, your spreads, your participation rates seem to coalesce around the 10th or 11th year. They're all about the same number. So if you're a long-haul thinker, really, I don't think there's a lot of rocket science that I need to employ at the front end of my contract from an index selection point of view. You concur with that?
I would concur with that, yes.
Okay, well, now let me just see if I can take you down the dark side here. And I'm not trying to do a debate here between whether annuities or life are better, but I just want to look at the mechanics. The cap rates on annuities are quite low. And there's a couple anomalies to what I just said, but by and large, if you saw a 5 or 6% cap on an index, that'd be a pretty good.
That'd be huge for an annuity, yes.
Right. So they have their expenses. If I'm sitting at a 10 or 12, I think I can get 10 or 12 cap on an index life all day long. So if I could match up to the tax issue first. So let's say I was willing to make an Index Universal Life contract a full-blown modified endowment contract. I'd lower the death benefit all the way down to the DEFRA corridor. There's going to be a crossover point when my life insurance, because of the uncapped strategy or the 12 cap or whatever that strategy is, which is usually 2 times at least, maybe even more than the annuity, all of a sudden the life looks like a play. If my client was kind of healthy, can I look at this as a legitimate discussion?
Even if your client's somewhat unhealthy or even very unhealthy, it still could be much better for him in the IUL contract if he's willing to fund his contract that way to get the much higher caps. The other thing that you didn't mention is even if we do have a modified endowment contract, the death benefit is still income tax free. When we have an annuity, the death benefit is going to be taxed to the beneficiaries as income in respect to a decedent. The life insurance contract does not have that tax.
Okay, so from a mechanic point of view, once I cross over 10 years, or my client's a long-term thinker, and 10 years is about the demarcation line for that, that's a horizon where I need to look at both of these contracts then.
I think so.
Okay, now let's say I look at that judgment and I go, I'm just going to back test both of them. What does that look like? And I look at some of the back testing and go, wow, I should have went with the life all along, right?
Right.
Then my second issue is for a little bit more bump in cost of insurance, should I trade my modified endowment life contract, which I was trying to match up to the annuity, should I actually move that up now to a non-modified endowment contract so I can take withdrawals to basis and policy loans of gain out free? Because the disparity's not that long, not that wide.
Right. That's something to look at. Given, and one of the things, when you're talking about funding a policy that way to the neck limit, in other words, putting as much premium as you could, given the death benefit, that's the opposite as the way most people buy life insurance. Most people try to buy as much death benefit with as little money as possible. If everybody were buying life insurance the way you describe, I don't think we'd see caps at 10 or 12% because the insurance companies simply couldn't hedge for it if everybody was doing that. The reason why people that buy their insurance that way get such a good deal is because the way most people fund their policy, they're not getting such a good deal.
Now, why would it in a person then, just from you're a CLU, CHFC, CFP. You've been in this business a long time. You have a huge retail practice. You own a PC shop. I'm just trying to think, okay, fine, but why would I just not buy guaranteed UL and not even mess with whether the index makes money or not? If I was just making a difference, like you said, on
I think there is a
indemnification.
place for guaranteed UL.
But what about if it's just a strictly death benefit indemnification call then?
I think with reasonable performance of the index UL is going to outperform the guaranteed UL from a death benefit standpoint as well as a cash value standpoint.
So you still have reasons to do the IUL even if the GUL was guaranteed and cheaper.
I sell more IUL than I do GUL.
And even if it's
most of my cases are death benefit plays.
Okay, so the client must see the value of that, right? Having some cash reserves to use, even if though they're doing it in a death benefit scenario.
Right.
Okay, now, in my book, and even our sponsor of our show, we do heavily accumulation on life, so I hope we're not hurting the carriers by going opposite of them. But when I think about what's going on right now, if I'm matching up, I've noticed that if I have a lot more room to play on my caps on life insurance, that if I can hold, if I'm a good holder for 10, 12 years out, I'm going to start winning on this issue. So I see the future, especially if we see interest rate tick-ups going up, we may benefit from that. The annuity will benefit, of course, but maybe life insurance itself will become another play to look at, and especially not only for income, but I'm suggesting maybe even, if you want to match up to the tax issues of an annuity, a modified endowment contract.
Right.
So before I leave the segment, what do you think when you're looking at index universal life? Can you give us a future? What do you think the future is going to be? A little more caps? Interest rate goes up and we're going to see much more uncapped strategies? What do you think?
You know, I think we're going to see caps hopefully go up over time. I believe that the NAIC regulations that limit the amount of caps, unfortunately, I think may disincentivize insurance companies to offer good caps.
Now, are they going to limit the caps, or are you just going to limit the illustration?
They're going to limit what can be illustrated based on a backtesting formula. And unfortunately, I think that has led to many carriers redesigning their products to make them less transparent. And I'm really for more transparency. I'd like to get in and find out how things work. And unfortunately, I think the current regulations have are going to lean to less transparency.
Well, for more information on the mechanics of Index Universal Life and how this information can impact your business, just click on the landing page address in the video description. And for more information on our shows, seminars, and workshops, just follow us on social media or visit us out on our website. I'm Steve Savant. We'll see you next time on Thought Leaders. And remember, keep thinking outside the box.